We're also here in person. I am Noelle Longmire. I'm the director of the Nest SoCal group, who is putting on and sponsoring the presentation tonight to give you a little bit of a homeowners workshop / market update for the real estate market here in the general Long Beach, Los Angeles County area. And I'm joined by some amazing panelists who are experts in their industries, Wendy Close with CLS Financial and Kim Terrell with Farmers Insurance, both of who are integral parts of our team at Nest SoCal. We highly recommend both of these professionals. I've used them personally, and I can't say enough about them. So I'll introduce them as they come up to talk about their segments today. But we're going to start with a little bit about the real estate market. So let me, you're seeing a screen share right now on Zoom and here in person. And I'm going to start back through here. There's me. I'm going to see if this works successfully to switch through the slides. And for those of you on Zoom that I can see, Kathy, I see you up there. We have a team member up on Zoom as well, a couple of team members up there. So if you can see it, just give me a thumbs up. Okay, thank you. I'm wondering if
try pointing at the computer.
I did.
Please continue. On the screen.
It's on this one. It's the screen. Here we go. Someone needs to manually help me. All right. So I'm just going to talk over here, and then we'll go. I feel like I need to be this way so I can talk to you here. We're gonna not have me on camera. That's okay. You don't need to see me over there, but I'm here. Okay. So we're going to talk, or I'm going to talk today about the real estate market update year in review. I want to give everybody a little bit of a sense. And the reason why we wanted to do this workshop was just to give everyone a sense of the synopsis of where we are now in September as we end the third quarter of 2022 to where we were at the beginning of this year. Because if you haven't heard it in the news, if you haven't been aware of it personally as a homeowner, if you were potentially going to be buying a home, selling a home, or just wanting to know what your overall values are, values have changed and the real estate market has shifted fairly significantly since the first quarter of the year to the current quarter of the year. So we're going to talk about that. We're going to look at year-over-year data just to look at where we are in space in comparison to the last several years, but specifically the last year in 2021. And then we're going to talk about the three major indicators of the real estate shift and why we are where we are. I'm also going to talk about your home value in general. What can you as homeowners do to make sure that you're maximizing the value of your home, making improvements that are smart and give you the best return on investment? And so we'll talk a little bit about that. And then what trends buyers in today's market as of 2022, what are they looking for when they're looking for a home? Because that is ultimately going to have an impact on whether or not you get the maximum value for your home. If you did think about selling, if that's something that is in your future, or even if you're doing a home refinance, if you're doing an equity loan, it's going to affect your appraisal value. And so those are some of the things that we're going to talk about as well. I am also going to just make a brief mention about top 3 ways that you can safeguard your home, which is probably one of the biggest assets any of us will ever have, whether it's our personal residence or investment properties. And we're going to talk a little bit about what are some of the top 3 things that you can do to make sure you protect that asset or assets. Okay. Thank you. So one of the things that I have a very specific example on, which I really felt demonstrated where we are now in the current market versus where we were at the beginning of the year, just as a demonstration to kind of illustrate the impact of interest rates and how that's had such an effect on our market and what's caused the shift, is this example. I had a listing that was at $1.25 million in the Tustin area. And in that area, homes back in February that were around $1.25 million were being sold at the time where interest rates were 3.65%. That was in February. What the going interest rate was for a 20% down loan with decent credit, no points, just a basic, straightforward, high balance loan. So that being said, the payment amount for this property at 1.25 with 20% down at 3.65% interest rate was $4,574.60. So buyers in February that were clamoring into the market, because that was the tone of the market in February, January, February into early March, when interest rates were at this rock bottom rate. When they were at that rate, we had multiple offers on every property. It was on the market for 4 days and you would get 10 offers, usually above list price, sometimes waiving all appraisal contingencies, sometimes even waiving inspection contingencies, just to secure that interest rate for a 30-year fixed loan. That was the tone of the market, and that was a lot of what was driving that, especially because there was no other inventory available. The inventory in February was less than 1.5 months worth of homes available for sale based on the demand. So with this payment example, that's where we were in February. The jump here to the end of August. I did this slide on August 15th. The rates were about 5.53 as of August. They're even higher now. So 5.53 for the same $1.25 million house. House didn't change. And the sellers, a lot of the sellers that were using the comparable sales from the first 6 months of the year, that were looking to say, oh yeah, these homes sold for $1.25 million. It would make sense that my same home that's comparable to those would sell for that. They were pricing homes at the same rate. But for buyers who then lost their tolerance level and had to pay 5.53% interest rate, we're now going to be paying $5,696.73 instead of $4,574. So that increase was basically the difference of over $1,100 per month for buyers for the same house in the difference between February to September. So guess what that did to the real estate market? We basically saw prices and listings that were priced during the time, probably about the end of May, when we really started to feel it through the summer. It was like, basically, we got a bad haircut and it was painful. It was immediately terrible. A lot of us cried. A lot of the sellers cried. It's pretty terrible. But the good news is it grows back, right? And when you get a bad haircut, eventually it will grow back and you'll recover from it. And so we're probably going to start to see that. But this is what has been driving the downturn in pricing. Now, when we started to see this same house now, if you looked at that so that it would be the same payment as what it was when people were in such high demand to buy, you would have to do a price reduction, almost 20%, to catch up with what the difference have been in rates. So that 20% reduction in price at the 1.25 is where that home should have been priced if it was in August. That's $1 million versus 1.25. For sellers, this is why we wanted to talk to you as homeowners, because this affects you as a homeowner. This is essentially the difference in value of where you are now versus where you were at the beginning of the year. So if you were to have had an appraisal to do a refi, and we have an appraiser in the house today, but if you had an appraiser that did an appraisal for you at the beginning of the year, they were using the comparable sales from that prior 4 to 6 months that could support that 1.25%. But now, if you're looking at closings within this last like 30 days to the coming few days, or coming like 30 to 60 days, you're going to see a drastic difference in pricing, which is going to affect your current home value. So don't be too upset if you're not planning on selling. You're just going to have to ride it out, because essentially this was a really inflated time period. So let's look at year over year. So we're going to look at the comparison between 2022 and 2021. And we're going to look at some major factors as to what this really looks like year over year. It's not as scary when you look at it year over year. From September to February, it was pretty scary, and everybody has been feeling that shift. But overall, it's not all bad news. This is where the hair regrowth can begin. So August of 2022, when we're talking about I'd say average sales price, this is for Long Beach. This is specific to Long Beach. I just pulled some statistics from the Pacific West Association of Realtors here in the area. So the average sales price here in Long Beach went down 5.2% when you're looking at year over year. That's not a huge difference year over year. That's not that terrible. What is interesting is what we're going to see as the major factors of what's going to be in the market to come. And that is going to be the pending sales, the days on market, and our months of supply. So when we're talking about pending sales, you can see the difference in how many new listings we had. It was 255 new listings in 2021 in August versus this past August was 138 new listings. That was actually significantly down, which is interesting. But pending sales was even more down. So things aren't selling as much or as quickly. And that's an indicator that also affects this number. That's your months of supply of inventory. Here in August of 2021, there was only 1.5 months of inventory supply, but the more things that don't sell keep adding to that. And so it's going to start to grow with months of supply as far as that inventory. Right now, we're still in that transition between a seller's market and a balanced market. A true balanced market is about 3 months of supply to 4 months of supply. A buyer's market is when you're more at the 4 months of supply where you've got a glut of inventory that's not selling. Right now, the indicator is we're still doing pretty good. When you're looking at average days on market, in August, things were selling real fast. This was even for the dogs, like real fixers, real ugly properties. Everybody and their brother was selling their property, moving out of state, you name it. Like anyone that put their home on the market, it didn't matter what it looked like. It didn't matter whether it was improved, it was selling. Now it's taking a little bit longer to sell that, but still we're talking about less than 30 days on the market. So it's giving us a little bit of an idea that this is not terrible. A long time on the market, and I can tell you, I've been in real estate for 21 years now. I was there through the 2009, 2008, 2009 crash. But when we were talking about like 2010, 2011, properties were staying on the market for months and not doing anything. So it's not bad news. It's just that we're shifting down into a little bit more of a balanced time period, which for buyers is actually good. It's not terrible for sellers because you can still get a reasonable price. We're still looking pretty good in regard to where average home sales are and the average prices are versus the last 5 years. It's come up significantly. And we're still selling within a reasonable period of time. And there's still enough demand that it's driving the market to be somewhat stable. It's not a crazy crash. So when we talk about, and a lot of people wonder, oh, the market's going to crash. We're in a bubble. We're going through the same stage that we did between 2005 to 2008. It's not the same. The factors are not there for a market crash right now. And so we thought we'd give everybody a little bit more confidence about the fact that we don't anticipate, nor do economists project, a crash for that reason. So this is a little indicator that it's going to get a little bit more balanced. And it might be a situation where you have to manage your expectations as a homeowner a little bit when it comes to your home value. You can't use your home as an ATM and take out a huge chunk of cash because you just have unlimited equity like we did. Like everybody was looking at the beginning of this year thinking, oh my God, my house price, my house value has come up 30% from what it was like 5 years ago. I can just take out as much equity as I want and do this or do that or buy toys or whatever it may be. So you might want to not get too crazy and stay conservative with what you do with your equity in your house. But at the same time, you still have a good amount of equity when we're talking about the last 5 years comparison.
No, I have a question.
Yeah.
Can you go back real quick? In that 138 versus 109, is 109 part of the 138?
So no, new listings are brand new listings.
Okay.
Pending sales are already in escrow
yes,
and pending the removal of contingencies. So they're getting ready to close. So this adds to the 109.
Okay.
So the new plus the pendings add into, the pendings wouldn't be included in the months of inventory. It's just how much less they are that are not selling. That difference is what's going to be added into that months of inventory.
Okay. Thank you.
It's not much different for condos too. It's a little bit actually better for condos because they're typically at a lower price point.
Okay, go ahead.
So let's talk about some of the things you might want to do when you talk about equity. Let's say, for instance, we were just talking about home equity lines of credit. If you wanted to pull money out of your equity or the value of your home as a homeowner, and you want to reinvest that intelligently so you have the best return on investment, the things that you're going to want to do are the things that you get the best return on. So the best rate of return. And these are what is currently being shown based on statistics that are collected by all these different data analysis from builders associations, National Association of Realtors, and some other organizations that have compiled a list of from 2022, what are your best return on investment types of improvements for your home. So I looked at the top 6, and these I can tell you from a real estate perspective, 100% are what we know buyers are looking for when we go to market a property, and when we're working with buyers, what they're looking for in a property. So top 6, number 1 was a minor bathroom remodel. That's an average budget of about $10,500. That typically is going to get you a new tub. That's going to get you a new tiled shower surround. That's going to get you some new high density flooring, whether it's the high density laminate, vinyl, if you're going to do anything with ceramic tile, porcelain tile, and a new vanity and new plumbing fixtures. So a $10,500 remodel is a pretty nice remodel. It's not upper scale. You might not be blowing out walls, but working within the 4 walls that you have of a bathroom, that's a decent budget. And you get about 102% return on investment for that. That's the highest return on investment of what people have been doing with their equity and adding value to their homes in 2022. That's made the most difference at resale. Secondly, landscaping. This for me is an absolute must. And I think any realtor would tell you the same thing. It makes the most amount of impact in regard to what buyers are looking for with a home. And it's the first impression that you give, but it does have a direct impact on your home's value. And that's landscaping. So when we're talking about landscaping, we're talking about some basic hardscaping, maybe redoing some of the concrete hardscape around the front, but also new plantings, cleaning up, mulching planter beds, basic, just simple stuff, cleaning up, tree trimming, like sometimes removal of some trees that are blocking windows. Those are the best types of landscaping improvements you can do to the front yard, and the front yard definitely trumps the backyard. I'd rather have somebody do nothing to the backyard and spend all that money in the front yard, because that's going to be the first impression that invites people in. And when they first see the house, that's going to be their impression of what's going to be the value of the interior. It's usually going to draw you in to think, oh, that's a home that I really want to see. If it's this nice inside, it's probably, or outside, it's probably that nice inside. And that's 100% return on investment. So that $3,500, you get that back hands down, no problem. Upgrading your garage door was actually a surprise to me, but it's a cheap way to make a nice fix up that does have an impact on curb appeal. So upgrading your garage door is going to be an average budget of around $4,300. That's a 99% return on investment. That, I mean, is pretty simple. So if you have a lot of people have dented their garage doors, have peeling paint on their garage doors, their springs don't work, or they haven't done an automatic opener. That's a worthy investment that you're going to get your money back on. Plus, it's super nice that you get to enjoy the convenience of a nicer looking garage door that's functioning. Number 4 is actually surprising to me that you don't get as much of a return on investment, but it's still pretty darn good. And this is what I normally tell people, is that kitchens and bathrooms sell properties. 100% it's on the list. I just was surprised that it was number 4, not number 1. But a minor kitchen remodel was what actually got the best rate of return versus a major kitchen remodel. That only got a 75% rate of return. So the minor remodels is what really was making an impact in regard to how much you were reaping at the time that you sold the property, if you were making that improvement for that resale value. So that would be things like new appliances, refacing of existing cabinetry, redoing countertops, and redoing flooring, but keeping the existing footprint. So people that were spending like, and so this is $15,000 as an average budget. That's not gonna get you new cabinets, I can tell you that much. But it definitely would help you with appliances and refacing. So that's gonna be a nice way, and the good news is it doesn't take that long. To a full kitchen remodel, you're gonna lose your house for probably about 2.5, 3 months to get the cabinets in. And with supply chain issues, I think that's probably been even more of a headache for people. So the minor kitchen remodels are a lot more convenient and time efficient as well. And that gets you that 98.5% return on investment. Plus you get to enjoy a nice, fresh, updated kitchen. Exterior improvements. This was number 5 on the list, and I was glad to see this because again, number 2, 3, and 5 here have a huge impact on curb appeal. Again, curb appeal and the overall look of your home has been the best rate of return as far as the investment options you can do for home improvement. So exterior improvements and an average budget around $7,200, you get a 95.5% return at resale. If you put in just exterior paint, people, just exterior paint, a fresh coat of paint is probably going to cost you typically around $4,000. If you have a single story home, if you don't have a giant McMansion, it's going to be around $4,000 to exterior repaint. That's usually with some prep work. Now, if you're going to add things like extra trim colors, like a different trim color or different column colors or accent colors, this might be a little bit more expensive, closer to the $5,500 mark, maybe $6,000. But that makes a complete difference in your overall look of your home and the value of your property as it's perceived by buyers at resale for sure. And then vinyl siding, if you do that, updated front doors is a huge thing. So invest in a quality front door. If you want to use your existing door and it's still in good condition, make sure that it shows nicely that it's painted, freshly painted, sometimes in a contrasting color. That makes a huge dramatic improvement in your overall value and the perception of your home. Number 6, this one is twofold, replacing your windows. Again, it's going to affect curb appeal because your windows definitely impact how your home looks, but it's also for energy efficiency. So an average budget to replace windows to the dual pane, high energy efficient windows, you get about $9,700. It's usually like $350 a window for standard size windows. Now, if you talk about sliding glass doors, they're a lot more expensive. They're going to be between $1,500 to $2,500 for a sliding glass door. Definitely worth it if you do it. And that might factor into that budget being a little higher, but you get an 89.6% return at resale for that investment. So these are the top 6 of where you want to spend your money if you want to preserve your equity and make sure that your money's working for you in regard to the types of improvements you do on your home. And this will help you continue to add value as you make improvements. So what are the top 10 features that buyers look for? What are the trends that buyers are looking for now? So you as a homeowner, whether you're selling, not selling, just thinking about making sure that you keep up with the trends and stay on that path of making sure that your home is appealing in the market in general, for whatever reason, if you wanted to do it for yourself, but also just for the potential value of the home. The top 10 features that buyers are now looking for, again, we're going to mirror some of the same things. Updated kitchens and baths, but a lot of these that we're going to talk about here are also informed by the pandemic. For all of us that have been through the pandemic, we were stuck in our houses for a long period of time, and that's definitely made an impact in how people want to live in their homes now. And so people that were in their homes trapped and had no space are looking for homes now that can accommodate the feeling of comfort, storage, all kinds of different things that they weren't looking for before. Open floor plans have usually been pretty popular over the last several years, but even more so now. So open floor plans where you have connected living between your kitchen, your family room, your dining area, more of an open concept, great room type of a feel. It's less of a thing that buyers are looking for, and they feel it's more wasted space if you have formal dining rooms versus a connected living space. And so that's one of the things that people are definitely looking for. Low maintenance features. really that speaks to the fact that nobody wants to do work on the house. So if they're gonna buy the house, they're looking for homes that are move-in ready. That means they don't want to replace a roof. They don't want to replace the windows. They want to make sure that you've already done those things. They don't want to replace the HVAC. They don't want to do work on major systems of the house that are going to cause them big ticket dollar items down the road. So that's actually more important than it has been in years past. Sorry, you could grab that. Our cleaning crew is working on the vacuum there. No surprise, also energy efficiency types of appliances and features. So smart home devices, high energy appliances like your dishwasher, your low flow toilets, your HVAC system. If you have solar power systems, that's a huge bonus now. Just be careful as to whether or not it's leased versus owned, because it doesn't add any value to your home if it's a leased system. So if it's an owned system, yes, it adds value. But if it's a leased system, it doesn't actually add value as far as the overall estimate of your home's worth. Wireless connectivity. All of us were working from home for a period of time for those of us that work. So wireless connectivity is absolutely a requirement now. So for anybody that has, whether it's a condo or whether it's an area where you have maybe a dedicated work from home area, connectivity is huge. So whether it's dedicated lines for Ethernet or signal extenders, make sure you think about those things when you're making improvements to your property. Laundry rooms I thought was interesting, but everybody was at home and, you know, surprisingly, nobody was really doing laundry because they were wearing the same clothes day in and day out. So that one surprised me. At least I know my children were, that's for sure. They maybe still are. But laundry rooms, so interior laundry rooms are a big deal, and that's actually having a nice space for an interior laundry room where you make improvements, and that's a big deal if you have the potential for an indoor laundry room, whether if you have a detached garage, you could bring it inside. It's a huge added value and something that has been on the top part of buyers' lists when they're actually asking for, when we tell them or ask them what their criteria are for homes when they're shopping for homes, laundry rooms are high up there. Patios, again, to extend your living space. Patios are a big deal now. So covered patios have become incredibly popular again. Sunrooms have become popular again. Any opportunity to extend the space of your house and your living opportunities so that you're not stuck in the house and can't go anywhere or be able to enjoy the outside. So patios are a big deal now. And garage storage space, just additional storage, and exterior lighting. I thought these two, again, were pretty interesting. I haven't seen that personally or experienced that personally, but that's on your top 10 features of what buyers are looking for now in 2022. Okay, talking about safeguarding, and then we're gonna introduce Wendy to talk a little bit more about interest rates and what the predictions are of where the market's gonna go. I'm just gonna get up on my soapbox real quickly because this is my big deal. I am a huge advocate in working with many, many clients over the 20 plus years I've been in real estate of people making sure that they protect their home in a trust. So if you are a homeowner and you do not have a trust, I'm talking to everybody out there. If you don't have a trust, I would highly recommend you establish a living trust. These can be revocable until you pass away, where they become then irrevocable, but it is to protect your asset for your heirs. If you have a will and you pass away, it doesn't mean that your property doesn't go through probate. So to demonstrate that, the cost or average cost of establishing a living trust is anywhere between $2,000 to $4,000 if you do it through an attorney, reputable attorney who will give you an entire estate plan, including your financial documents and healthcare related documents, and then you record your property in the name of that trust. That is a key point here. Record the property in the name of the trust. It's a quick claim deed that takes it from your personal name to your trust name at the county recorder's office. It costs you about $23 to record that deed. It's not a big deal. But if you do that, spending that $2,000 to $4,000, it's going to save your heirs a potential $21,000 in statutory probate fees. If you pass away and leave them an estate home with a home in it that's worth $900,000, that's what it costs right now to go through probate in California. And that's just the basic probate fee. It doesn't talk or speak to how long that's going to take and how much paperwork nightmare your loved ones are going to go through if they have to go through probate versus a trust. So I highly recommend you protect your asset with a trust. Secondly, there is another option that not a lot of people are aware of, and it's really more of a fail-safe protection to stave off creditors if you get into trouble, and that's declaring a homestead. Not everybody is aware of the homestead declaration option. This is only relevant to properties that you live in as your principal residence. So if you're living in it as your primary home, you can actually, there's a form online, you can look up Declaration of Homestead in California. You fill out a form and file that, and if it qualifies as your principal residence, it basically protects a portion of your equity and preserves that so that if you were to file bankruptcy, if you were to have creditors coming after you, they can't necessarily take your house. It preserves and protects some of your equity, at least a portion of it, or it can extend the period of time in which creditors can come after you. So I highly recommend you talk to an attorney about what the impact is of either of these, because I am not an attorney and I cannot give legal advice. Okay, so I have to, that's my disclaimer, everybody. And then number 3, this is where Kim's gonna help us today, and that's securing adequate homeowners insurance. Homeowners insurance is something nobody thinks about until they need it. And I can tell you from personal experience and from nightmare stories that my clients and family members have experienced, that homeowners insurance is definitely something you need to educate yourselves about and make sure that you're prepared with appropriate coverage. That's both for potential restoration and repairs to take care of damage that happens to your home due to fire, natural disasters, and things like damage, theft, vandalism. Also personal liability and protection for lawsuits that might be filed against you by others that might fall on your property, get bitten by your dog, that kind of thing. And there's certain minimums that you probably want to preserve, but there's some other things that not everybody thinks about. And Kim has taught myself and some of our team members here that we have to educate our clients about. Things like if you buy a house and you're not going to move into it right away because you're going to do some major renovations to make sure all that equity is maximized. If you're doing major renovations and you aren't moving in for more than 30 days, you have to tell your homeowner's insurance company. There's a rider that they have to add to your policy or you are not protected. So most people don't know that. And I will let Kim go into more detail about some of those items today. So that's my soapbox. That's a little bit about where we are right now in the real estate market, what we're feeling from a real estate perspective. And the good news is it's not all terrible. It's just that we need to manage our expectations now and be realistic about where values are now versus where they were at the beginning of the year. But overall, we're still doing pretty darn good. Okay, so I'm going to introduce Wendy with CLS Financial, who's going to talk to us a little bit more about why interest rates have risen and what the projections are for the rest of this year into 2023. Thank you.
You're welcome. And just real quick on that, my name is Wendy from CLS Financial. In regards to a trust, it's just really important that you find a lender or a bank that will fund into a trust. Especially if you refinance, it's critical that you make sure that they didn't fund into the names personally and they actually got the house put back into the trust. And so that's one thing at our bank. We have a whole trust department and we fund into a trust, and that's unique. So that is important. And I find that a lot of people, when they did their refinance, unfortunately, I don't think things were happening so fast. They maybe didn't really look into the details of making sure their home got put back in the trust. Anyhow, I've been doing this 26 years and branch manager at CLS Financial. We also produce and we are a direct lender and are very grateful to be here. And we're going to talk about rates, as Noelle said I was going to. And there's many ways that the rates are impacted. And one of the big ones that we all know and felt was the global pandemic. I know it's over there to the far left. And as you know, the global pandemic really got the rates lower than we've ever seen in all times. Really between that, stocks and bonds, what's happening with inflation right now has impacted the rates. Rates have gone up with inflation. The Fed makes announcements. One of the biggest things that people think is when the Fed talks about raising rates, it's short-term rates, it's not long-term rates, but it's always gonna have some form of a knee-jerk reaction to how people are going to respond. But they don't control the long-term rates. It's the short-term rates, and kind of like what would happen with the home equity lines of credits and those kinds of things. But they do have an impact when they start making statements that will impact rates to either go up or down. The economy and what's happening with the economy, same thing. All of this is either brought the rates up or down. And with all of it, there are a lot of factors, and I think we've seen things that we've never seen in the last few years, which means we've also seen rates that we haven't seen ever. So we all need to have perspective to know that that is not the norm. And I think the next slide will kind of lead into that.
Can you explain the difference between short-term and long-term rates? Because a lot of people don't know what that means.
Yes, so long-term is a fixed rate, and that would be like a 30-year fixed versus say like any of the fixed rates. When you're talking about short-term rates, you're talking about like the LIBOR, just depending on the different indexes, they're impacted more so by what the Fed controls and how the rates will be determined. Now, when you're talking about the long-term rates, those are not impacted by the Federal Reserve, but the Federal Reserve statements and what they say does form some chaos or havoc in the news, and a lot of things can also make shift in the market based on what people choose to do with their money, with the stock market and bonds and all that kind of stuff. So, all right. So speaking on rates, as you could see, I know I bought my first house and it was almost 8% rate, and I was doing a dance that it was under 8%. So I think the rates are still very low. It's all perspective, right? So if you look here, we have rates here. This is 1992, right?
Yeah.
So I should be wearing my glasses. 1992 till now, and you can see the rates were here, and they even went up above in the like low nines, like 9.25, and we're still all the way down here. So I think it's just when you look back, you're like, wow, are rates really high? No, they're not really high. They're still very low. I think it's just really what we've seen is skewed our perspective also. What Noelle said was really true though. I mean, it's hard for the people that were out there buying and they see that payment shock. And that's why today she really wanted me to bring some solutions to everyone.
Yeah.
Because we need to say, how can we overcome that? Because we know if there is going to be a rate drop, which I will talk about that, there'll be an opportunity to refinance. So, all right, we'll go to the next slide. So speaking on, if there was just a 1 point difference, I know Noelle brought up, there was almost a little, like about a 2 point difference in her scenario, and it was about $1,000. We have about $515 in a payment change with a loan amount of $800. So if you went from 5.5 to 6.5, you're looking about a $515 difference in payment. So we do need to understand, yes, it does impact the payment. Noelle touched on that in her scenario, her real personal situation that happened to one of her sellers. And this is one just showing you around an $800,000 loan amount, what that would look like. So today, if you're looking at a 5.5% rate, rates have been, I would say in the last few months, we got some back down to about 4.75, but all the way up to 6.75. So it's been all over the place.
Yeah.
The last few months or 6 months.
Yeah, rates change daily.
Daily. Oh yeah, that's on another slide there. So we have $4,088 here at 5.5, and then $4,400 there. So we know that the rates right now, I think I'm comfortable saying they're in the fives. They are predicted to go up for sure before they're going down. So do I think it's a great time to buy? I think it's an absolute fabulous time to buy because you still can save yourself about $400 a month by not waiting, and because they are predicting rates to continue to rise, and I'll discuss that. Right here, if you look here, what that means for you, you have a $390 a month. When I said almost $400, that's a car payment. If you look at it annually, you could go on a family vacation, $4,600, and over 30 years, that would be $140,400, which could really impact, your future retirement and what you can do with that money. couple of the solutions, as I want to bring solutions and hope, is we do have one solution, is the 2-1 buy down, which I'll share with you. Also, as Noel said, that we're coming to more of a balanced market, and when you hit a balanced market, then the sellers are more willing to negotiate. And seller credits are given more often than if it's the complete seller's market. So you'll look at ways that you can use, instead of the seller maybe doing a large price reduction, there's other creative ways that they can help the buyer with any of the payment shock, or if them feeling it's not in their budget. So how can we get that payment down for them? Also, staying in a conforming loan limit, we're very fortunate in LA and Orange County. We have high balance and conforming and also jumbo. So we are finding that conforming and jumbo rates are a bit lower than the high balance at this current time. Conforming loan limit just got increased. They're predicting to be at 715,000. So we saw a pretty good increase there of about $65,000, which I feel like helps a lot of people who are maybe not able to afford here. And now they can go buy it in Riverside County or San Bernardino County, because before they could only get a loan amount of 647 or go right into jumbo. And that's like 5% down. And then they could go in at the 715, the loan amount, not purchase price. So I think it really opens up more opportunity to people to get into a home, maybe who wanted to be in a larger space and not being able to afford it here. And they don't maybe afford a condo townhouse here, but need a larger place for their family. Maybe they're willing to move to Riverside or San Bernardino. Now there's that 715. I think that will help a lot. Float down. The banks are back from when the refinance time was. They weren't floating down, but great news is that if the rates do drop, you lock in your rate. They'll float down the rate for you, and it just helps you feel a little bit more peace of mind to know that that's an option. And we have a lock and list for those sellers, people who want to go in and list their home. We could lock in a rate for 4 months, and if those rates drop at time of docs, we can reduce the rate down to where it is at that time. So I know I literally had 2 people this week ask, can you lock in my rate now? But they want to keep their home. They don't want to sell it. I'm like, well, the lock and buy is 2 months. The lock and list is the best thing. We've saved so many people money on the lock and list, but you gotta list your house. So
You have to be ready to sell.
for the
if
4
you're gonna
months,
sell.
yeah. All right, so what is a buy down? So basically, you're able to keep the payments lower because you get a 2% lower rate from where it is at that current time. So it's basically, it's different from using points. A lot of times when I say the seller, the permanent buy down would be as if the seller was going to give you seller credits to help you buy down the rate, and then it would be that rate for good. This is a temporary buy down. So basically, it would reduce the rate 2% the first year, 1% the second year, and the third year it would go back up. And we're hoping between that time, there'll be a great opportunity to refinance. And then also people's income, typically, depending on their industry, may have seen some increase in a raise or something of that sort. So we can go to the next slide. So you see here, year 1, there'd be a 2%. Year 2, 1%, and year 3 would be the plan. So if you started at a 6%, say rates are 6% right now, you would start at 4% and then go to 5%. And you could see the difference in payments. So year 1, it's almost $1,000 savings. And year 2, it's $500 in savings. And then by year 3, we're hoping for a refi, or they have a raise, or something's changed in their life, and they feel a little bit more comfortable with this new change of becoming a homeowner. All right.
Just know eventually you're gonna pay that higher rate
Yeah.
unless you refi.
And so what happens is that the seller will pay the interest up front. So this is kind of like a calculator to show you what the interest is. So they'll show the P&I payment, what's bought down, and all of that across the board. So here we're looking at about, the total's almost about 18,000. So the videos are. Okay, yeah, it's just about there. So 17,746 is the total there to get someone's payment down 1,000 the first month, 500 the next. Now, I feel like that's really dramatic. Instead of someone doing a $50,000
Price
reduction in price, I think they're going to get a lot more from this. So if you are thinking of selling, I think looking at a disclaimer that you could put that you're willing and open to having these discussions to helping the buyer instead of having to do a dramatic. Because if you were to drop the price 50,000, you're not going to save that buyer that much money. And a lot right now is all about payment, as Noelle was saying. You have one here, one price point here, and would have to drop 20% for it to match up. So it's just like, where do you meet the buyer where everyone feels comfortable and everyone wins? So
This is why you need a good realtor and a good lender.
yeah. So this is the permanent buy down that I was talking about, like where is if you bought down points, a seller can give credits towards closing costs to buy down. The scenario shows a 20K price reduction versus a 16K seller to credit to buy down the rate. So if you did a $20,000, there'd be a monthly of 100. If they bought down the rate, 2%, or what was it, 1%? Hold on.
1%.
1%, sorry, I'm back on the 2 on buy down. 1%, you're saving a $500 savings. So again, doing a price reduction isn't gonna always help the buyer. They think sometimes it might. But I mean, there's two. There's the permanent one where they don't worry. Once they buy it down, they buy it down. But it costs a lot more and they're not gonna get as much of, the temporary buy down is really helping a lot of people. But this is an alternative to that if people don't feel comfortable with the temporary and they want a permanent. And I think that right now we'll see sellers being a little bit more flexible with helping.
Yeah, we're having to get real creative.
Exactly. Okay. All right. So as we talked about the Fed stated in the last meeting that they plan to increase rates, which is because they're trying to battle the inflation issues and that they're expecting in the middle of 2023 for the rates to go down. We've heard this a lot. So I'm hoping and praying every day and night that this happens, but we wish the beginning, not the middle. Let's say the beginning of 2023, but yes. So one other thing is our secure lock, and like we talked about the lock-in list. So the lock-in list is 4 months. So this is a solution for those looking to list that are concerned about rates. And if you guys want to know what that looks like, Noelle or I can share that information with you. It's a big win. I think that's it. Yeah, and then there's Kim talking about insurance. I hope that helps. Is there any questions? Oh, okay.
Thank you. Not where to stand.
I know, it's weird.
Okay, so my goal is not to bore everybody tonight with insurance. So I'm gonna keep it super simple. And the real goal is you get some good takeaways that you can use to take back to your own insurance policies and review them. So next slide. So super simple deductibles. But one of the biggest mistakes we see buyers make, we work almost entirely with first-time home buyers, is deductible amounts. Most people, when they're calling in to file a claim or they have any questions on their policies, have zero clues what their deductible is. Does anybody here know what their deductible is? So the answer is no. And so a lot of times people have a policy and they have no clue what their out-of-pocket expense is going to be if, heaven forbid, they have a large claim, like a pipe could burst in your house, there could be a fire. We get a lot of people that at some point have decided to lower their insurance premiums. They have $5,000 deductibles on their house and there is absolutely no way they can put together $5,000 to pay for a claim. So my first tip of the night is, if you take away anything at all, it's to pull out your insurance policy and look at what your deductible is, because when you are buying a house, that first thing is, I need to condense like everything that's coming out of my account right now, and insurance premium is one of them. Unfortunately, if you call an insurance company and want to do that, the first thing they're going to do is bump your deductible up. So my first tip is make sure that it is something you can easily come up with, heaven forbid you were to have a claim on your property. And then also just know, if you lower your deductible amounts, it's not necessarily sometimes going to cost you a ton of money. So you can have a higher deductible and lower it down to, let's say, $1,500. And really at the end of the day, you could be saving less than $100 a year, but that's going to be a big hit if you ever have to file a claim. So deductibles, look at your policies and make sure you know what that is and you feel comfortable. And next slide. So things your insurance company needs to know. And Noelle kind of touched on this a little bit. I'm bringing these things up because heaven forbid you have a claim. You want to make sure your insurance company covers that.
Yes.
If you have a claim and your insurance company does not, like, a home is one of the biggest assets you're ever gonna have. And not having a covered claim when it is a large claim could be like life-changing. So if you're renting out a room in your house, we're seeing this a lot, especially with COVID. People were moving in together, people lost jobs, families started to combine and live under the same roofs. If you have any rumors or boarders, the insurance company does need to know about that. We had an incident where somebody fell down some stairs. We were unaware there were rumors of boarders, and it was not covered under insurance. So it is absolutely detrimental that your insurance company knows you are renting out a room in your home. The next is that everyone over the age of 18 is listed on your policy. So if they are permanently living there, using that as an address, they have to be listed on the policy. Liability does not extend over to them. Their personal property is not covered. A good scenario for this would be, we had a fiance move in, brought his dog. The fiance was not listed on the policy. The dog ended up biting an Amazon worker, and we had to work miracles to get that covered. It happened to be a really good friend of mine too, so that was not a good claim to go through. So you need to make sure everybody that lives in the house over the age of 18 is covered, because again, you are protecting that asset. That is the whole goal of that. If you have any animals in the home, specifically like obviously pit bulls, certain types of dogs and exotic animals, you want to make sure that the company knows that, and the company does insure that specific animal. You do not want to find out after there's been an issue and it's not covered. And then if you have any personal property of high value, so this goes unnoticed by virtually everybody until somebody brings it up. So we had somebody call the other day, it's $100,000 worth of guitars. We don't cover $100,000 of guitars. So typically if it is a high theft item, jewelry, furs, goldware, silverware, rugs, 100,000 in guitars, that is something you would want to add additionally to your policy as an endorsement, and it's fully covered. So full value, usually they may want to see an appraisal on it, but just know that is typically an exclusion with every single policy. And then as Noelle touched base, so I've done a really good job with my trainings, is if the home is vacant for more than 30 days, specifically because of renovations, doesn't mean you have to be buying the home. If you're doing remodeling and you're not living in it, the insurance company does need to know, because if they come out and there's no furniture or it doesn't look like you're living in the home, they're going to automatically assume that it's been vacant. So really big, you don't want to find out if a pipe bursts and the home is vacant, there's zero coverage. And when you do sign that application, and like all the tiny little print, it says all of this, and nobody really typically reads it. So just some stuff for you guys to take to use when you are reviewing your policies, and then I will go to the next slide. And I really want to touch base on claims. A lot of people don't think about this because they want to hope they're never going to have to file a claim on a policy. But if you file a claim on your insurance policy, it does impact you. So it impacts your rates first and foremost. So unlike homeowners insurance, if you're at fault, it impacts you. With your home, you're always at fault, or the home's always at fault. So the claim will always impact your rates. You lose a 3-year claims-free discount and a 5-year claims-free discount. In addition to that, though, what a lot of people that own homes don't know is it's gonna stay with the home.
Yes.
So if you are going to eventually become a seller, you need to know that that claim will follow the home and then impact potential people buying the home. So I never try to discourage people from filing a claim, because that is what you're paying for insurance. But the 2 tips I can give you if you've ever had damage to your house is, one, making sure you know if the amount is over the deductible amount. So we get people that call in all the time and it's like really small stuff. And with some companies, they'll just file the claim. Like if you want it and you want to find out about it, it will just go through. Nobody will guide you through that process. And so now you have a little red flag on your policy. So if you go to get insurance elsewhere, or somebody's buying the house, that little red flag pops up. And we don't get a ton of information. So if it's a little leak, there's not really much damage. Now the insurance company you want to switch to, or the new buyer, they can go in and see, oh, there was water damage to this house a year ago. And it might not have been anything big, but the insurance companies don't know that. So one, you always want to make sure it is over your deductible amount, and you want to make sure it's a covered claim. I would highly recommend never calling and just saying they need to file a claim. I would find out first and foremost how much you think it's going to cost. And then is it something that's covered? Because a lot of times we also get calls where it is 100% not covered. I already know that out the gate. And we'll advise to see if they want to get it covered. Usually they'll have a contractor out. If it looks like it's going to be more than they're anticipating, then we file the claim for them. But it's just knowing that up front. Again, never deterring people from filing claims, but just understanding also how it impacts your property and potentially your rates. And then I'm going to end with the last one. I'm like, oh, I don't know what it is.
There you go.
Oh, here we go. And then just a few tips for you guys. So earthquake, the number one call we get is earthquake covered under my homeowner's insurance policy? It is 100% never covered under standard homeowner's insurance policy. You do need to get a separate policy for that. It is a companion policy to the homeowner's insurance policy. And it usually costs just as much as a homeowner's insurance policy, which is why probably like 5% of people in California carry an earthquake. But if it is something you're concerned about, you do have to get a separate quote for that. Homeowner's insurance does not cover wear and tear. So as a homeowner, if you are concerned about appliances, your AC unit, anything like that, you want to make sure you renew that home warranty or you look at getting the home warranty. But in terms of wear and tear, it won't cover if your roof is 30 years old and you've not done anything with it and it starts leaking. So part of that would be making sure you have people coming out and inspecting the roof potentially. You can get warranties for that. And then in terms of plumbing under the house, having your husband go underneath there and take a look at it once a year like I do, and he hates me for it every year. He also does a little inspection of the roof, and I don't think he enjoys that as well. And then I think I have one more tip, but it's not showing up on here. So my number one tip is just making sure you're upfront with your insurance company. Now you guys have to stare at me.
There it is.
It's just making sure you're upfront with your insurance company. So the biggest thing we see most of the time is people are afraid they're going to get canceled. So they just opt not to say anything at all because they're worried about it. You are 100% better off getting canceled. There is nothing that I've seen so far, and I've been doing this for like almost 20 years, that is uninsurable. So you are better off getting canceled, finding out that it's not covered, than having a claim and finding out it's not covered. So hopefully I did not bore you. I talked super fast and I jammed through it, which is probably good for you guys. And then I think my insurance information is somewhere. So if you guys ever have any questions, and I appreciate your time.
Nice job, you guys. Thank all of you very much. Thank you, Kim.
Thank you so much for coming. For all of us, for those of you that are here in person, those of you who are here on Zoom, we are going to send you via email a PDF version of the slideshow today, as well as the recording of this Zoom, so that you have the benefit of looking back on this if and when you ever want to revisit this information. But at the same time, we just appreciate you coming today. Thank you very much. Thank you to Wendy and to Kim for taking time out of your schedules tonight to help provide some of this information. These are some of the things that homeowners don't necessarily think of all the time. I know I've had personal experiences with homeowners insurance that maybe didn't go as well as it could have, or family members, but I definitely know that this is an issue for clients with homeowners insurance. The good news is we will very, very soon see what's going to be happening with interest rates, because the Fed meets on September 21st. And they're going to be having that meeting to talk about what's going to happen with whether or not how high the rate hike is that they're anticipating. But again, mortgage rates aren't directly associated with what the Fed does. It's just the impact of what the news is and what happens with securities in the bond market after that announcement happens. So stay tuned. We might be doing another one of these in January. Thanks again for attending, and have a great evening.
Thank you very
Thank
much.
you.
Nice to meet you all.
Thank you.
Thank
you.
Thanks, guys.
Bye.
Thank you.
Thank you.
I mean, if they're over the age of 18, like on an insurance policy, I mean, there should be no additional fee to add them, but yeah, absolutely. I mean, because the terminology